Have you ever, just felt the need for absolute clarity about your money, like where it really is, whether that's personal savings or maybe thinking bigger, how a business keeps track of its cash? That feeling of wanting to know, okay, is every single dollar accounted for? Nothing missing, nothing, well, off. Well, today we're doing a deep dive into exactly that. Bank reconciliation. It might sound a bit technical, but honestly, it's crucial for understanding financial health. Our mission here is to really unpack the source material we have, specifically from Farhat lectures. We want to get a solid grip on what bank reconciliation is, why it's so important, especially as an internal control, and how it actually works day to day. We think there are some perhaps surprising practicalities here that are really essential to grasp. But before we dive deeper, just a quick reminder, this deep dive is based on material from Farhat lectures. All the content, examples, and the explanations we'll be discussing today are derived from the comprehensive accounting resources over at farhatlectures.com. So whether you're an accounting student, maybe studying for the CPA exam, or already a professional, definitely visit the website. They've got additional practice questions, video lectures, and tons of detailed support to help reinforce today's topic. And a special thanks to Professor Farhat for providing this valuable material for us to explore. Okay, let's unpack this then. Bank reconciliation. Sometimes it gets a reputation for being a bit dry, right? Academic even.
It can seem that way.
But its real world importance is huge. So to kick us off, maybe think about it like this. Checking your luggage after a long trip. You think you packed everything carefully before you left.
Right.
And when you get back, you open that suitcase and you go through it, comparing what you thought you packed against what's actually physically there.
Making sure nothing got lost or broken or just plain forgotten.
Exactly. It's that kind of careful, meticulous comparison.
That's a really good analogy, actually, because just like checking your luggage against your packing list, a business uses bank reconciliation to compare its own internal records, specifically its cash general ledger, with the statement it gets from the bank. The whole idea of reconciliation fundamentally is just taking two different things and lining them up side by side to make sure they match.
So what the company recorded versus what the bank recorded?
Exactly. You want everything the company logged to show up on the bank side, and everything the bank statement says needs to be accounted for in the company's books. And, this isn't just some routine chore accountants do.
Mm-hmm.
It's genuinely one of the most critical internal controls for a company's cash.
Because cash is so liquid, so vulnerable.
Precisely. So bank reconciliation helps make sure everything's accounted for. Nothing's missing, nothing's recorded wrong. It's like an early warning system, catching mistakes before they become big problems. And in the real world, professionals are doing these reconciliations constantly, maybe weekly, definitely monthly. It's that vital.
Okay, so given how fundamental this is, it makes you think, what is the bank actually doing that helps with this control process? It's obviously more than just, holding the money safely.
Oh, absolutely.
Yeah.
Secure cash storage is the obvious one, sure. The bank gives you a safe place for assets and handles the transactions. But the really key idea here is that both the company and the bank are keeping parallel records of all those cash movements.
Right. Two sets of books, essentially.
Exactly. You've got your cash account in your accounting system, and the bank has its own record of your transactions. That dual record keeping is the very basis for reconciliation. It's a built-in control right there. But beyond that, banks offer other services that really boost financial control. Think about signature cards. You fill those out when you open an account. Now, banks don't check the signature on every single check, of course. But they keep these cards on file. They might pull them randomly, or definitely if they suspect fraud, to help verify if a transaction is legitimate.
Okay, so it's a verification tool.
Right. And then you have deposit tickets. When you make a deposit, you get this little slip, a source document. It details exactly what you deposited: cash, coins, checks, the amounts. It's proof. It ensures accurate records. Another key control.
Makes sense.
And something else that's quite interesting is the use of multiple bank accounts. Companies do this a lot. They'll set up separate accounts for specific things.
Like payroll.
Payroll is the classic example. A company might transfer, say, $25,000 each week into a dedicated payroll account. Then all the employee payments, whether checks or direct deposits, come out of that specific fund.
Ah, I see. So how does that act as a control?
Well, imagine someone tries to withdraw more than that $25,000. The account goes negative immediately.
Ah, red flag.
Big red flag. It alerts the company right away to potential unauthorized activity. This kind of account, fronted with a specific amount for a specific purpose, is often called an impressed account. It usually gets reset, often back to zero, after each cycle, like after payroll is done.
Compressed account. Okay. I hadn't heard that term before.
Yeah, it's a neat control mechanism. And then, of course, there's electronic fund transfers, EFTs. They're everywhere
Oh,
now.
yeah, definitely. So much faster.
So much faster. Convenient, quick, generally cheaper, too. You think about the difference with old school checks. You write it, mail it. Takes days.
Yeah.
The recipient deposits it. Takes more days for the bank to clear it.
Right. It could be like a week easily.
Easily a week, sometimes longer. But an EFT, boom, you can transfer funds in like a minute, basically.
It's funny, though, isn't it? Businesses generally want to delay paying out money, but get money in instantly. EFTs kind of speed everything up for everyone.
It's true, it changes the timing dynamics, but both checks and EFTs serve that core function, instructing the bank to pay someone. And a check, for instance, gives you tons of control information. The date, who it's paid to, the amount, crucially, the check number. You need that to track every single, check the purpose, who signed it.
Right, a whole paper trail.
Exactly. And EFTs capture similar data, just electronically, so you still have that audit trail. And finally, the big one for reconciliation, the bank statement. That comprehensive record from the bank is what you're comparing everything against. It's central.
That really paints a clear picture of the bank's role in control. Things like signature cards, those impressed accounts. I hadn't really connected them directly to the control aspect like that. But okay, if both the company and the bank are keeping these parallel records, why are the balances nearly always different at month end? What's going on when, like you said, my books say $8,000, but the bank statement says $7,465?
That is the core question reconciliation answers. And it almost always boils down to two main reasons: timing differences and, well, errors. It's incredibly rare for those two balances, the book balance and the bank balance, to match perfectly on any specific day. Our job as accountants is to figure out why and make sure they eventually reconcile to the true cash balance.
Okay, so timing and errors. Let's break those down.
Right. Let's start with adjustments we make to the bank balance side of the reconciliation. These are things the company knows about, but the bank doesn't yet. The classic one is deposits in transit. This is money the company deposited, recorded in its books, but the bank hasn't processed it by the statement date.
Like dropping off a deposit late on the 31st.
Exactly. You make a $3,000 deposit after the bank's cutoff time, maybe 3 p.m., on July 31st. It's in your July books, but it won't show up on the bank statement until August 1st.
So what do we do with that?
To reconcile, we add those deposits in transit to the bank statement balance.
Okay, add deposits in transit. What else?
Then you have outstanding checks. These are the opposite, kind of. Checks the company wrote and recorded, reducing its cash balance, but they haven't actually cleared the bank yet.
So the recipient hasn't cashed it.
Right, or maybe they have, but it just hasn't fully processed through the banking system by the statement date. Imagine you wrote a $500 check for, say, cleaning services on July 27th. You recorded it, but maybe the cleaning company holds onto it for a bit, or it gets lost in the mail temporarily. It won't hit your bank account in July. So for reconciliation, these outstanding checks are deducted from the bank balance.
Deduct outstanding checks. Got it. Any others for the bank side?
Well, sometimes they're just plain bank errors, mistakes the bank made. Maybe they added money to your account that wasn't yours, or more commonly, deducted something by mistake.
Like for someone else's account with a similar number.
That happens all the time. Or just a processing error. These aren't timing issues, they're actual mistakes. They often take some investigation and a call to the bank to sort out. But you'd adjust the bank balance accordingly. Add back money wrongly deducted, or deduct money wrongly added.
Okay, so deposits in transit, outstanding checks, and bank errors adjust the bank statement balance. Now, what about the flip side? Adjustments to the company's book balance. What does the bank know that the company doesn't yet?
Exactly. Now we're looking at things on the bank statement that require the company to update its own records. For example, interest earned on the account. The bank adds it, but you might not know the exact amount until you see the statement. Or maybe unrecorded cash receipts, like a customer paying you directly via an EFT straight into your bank account.
Ah, so money came in that you didn't know about yet.
Right. The bank recorded it, you haven't. So if you earned, say, $10 in interest, or a customer EFT if $200 came in, you need to add these amounts to your company's book balance. Add interest and direct receipts. Okay, what about deductions from the book balance? Common ones are bank service fees. You know, that $20 monthly maintenance charge, or fees for check printing or wire transfers. You usually only find out the exact amount from the statement.
Right, so you deduct those.
You deduct them from your book balance. Another really frequent one is an NSF check, non-sufficient funds.
A bounce check.
Exactly, a bounce check. A customer pays you, maybe $300.
Yeah.
You deposit it, record it as cash received in your books. Then a few days later, the bank tells you the check bounced balance. The customer didn't have enough money.
Ugh. So you thought you had the cash, but you don't.
Precisely. So since you initially added that $300 to your cash balance, you now have to reverse that. You deduct the $300 NSF check from your book balance. And sometimes the bank charges you a fee for handling the bounce check, too, which would be another deduction.
Double whammy.
Okay. And the last category, sometimes the trickiest to find, are company errors. Mistakes made right in the company's own accounting records. Maybe typing the wrong amount for a check or a deposit.
So not the bank's fault this time, it's ours.
Right. For instance, maybe you wrote a check for the correct amount, $345, but the bookkeeper accidentally entered it into the accounting system as $354.
Okay, so they recorded spending $9 more than actually happened.
Exactly. Which means your cash balance on the books is currently understated by $9. The fix, you need to add $9 back to your cash balance in the books, and you'd also adjust whatever expense account was wrongly charged that extra $9.
Got it. And the other way around.
Yep. Same $345 check, but this time it was recorded as $330.
So recorded spending $15 less than actually happened. Cash is overstated.
Perfect. Your book cash balance is too high by $15. To fix it, you need to deduct another $15 from your cash account in the books and adjust the related expense. And the really critical thing here, any adjustment you make on the company's bookside interest, fees, NSF checks, errors, requires a journal entry in the accounting system to make the correction permanent. Adjusting the bank side doesn't usually require a journal entry from the company because those are mostly timing issues or bank errors that will resolve themselves or need bank action.
That makes perfect sense. The journal entry locks in the correction on the company's actual records. This whole breakdown really clarifies where all those differences come from. Okay, let's try and put this into practice. Let's test our understanding with a multiple choice question, one straight from the source material. I think seeing a concrete example will really bring it all together.
Sounds good. Let's do it. Here's the question. The bookkeeper incorrectly recorded a bank deposit as $840, but the bank recorded the deposit at its correct amount of $420. How will this error be treated on the bank reconciliation?
Okay, so first step is figuring out who made the mistake.
Right. The question says the bank recorded the correct amount, $420. The bookkeeper recorded it incorrectly as $840.
So the error is on the company side. It's a book adjustment.
Exactly. It's not a bank error, it's a company error. So we know we're adjusting the book balance, not the bank balance.
Okay. And the impact. The company added $840 to its cash records.
But only $420 actually went into the bank.
So the company's books think there's more cash than there really is. It's overstated.
Right. By how much? The difference between $804 and $420.
Which is $420.
Correct. The company's book cash balance is overstated by $420. So to fix this, what does the company need to do to its book balance?
It needs to reduce it, take away that extra $420 that isn't really there.
Precisely. So the error will be treated as a deduction from the book balance.
A deduction from the book balance.
Yeah.
And because it's a book adjustment,
It needs a journal entry to make the correction official in the company's accounting records. Probably debiting something like accounts receivable if it was a customer deposit error, or crediting cash.
perfect. That example really locks it in.
Wow. You know, this deep dive really shows how bank reconciliation isn't just like ticking and tying numbers. It's giving you this vital, accurate snapshot of a company's financial health. And it's such a powerful internal control running constantly in the background. Understanding these details, these nuances, it really makes you feel much more informed about, well, the backbone of financial integrity for any organization.
It really does, and it makes you think, doesn't it? In today's world, with so many electronic transactions, real-time data flying around, what new kinds of discrepancies might start popping up? And how will these core principles of reconciliation, comparing two sets of records, how will they need to adapt to keep ensuring financial integrity in the future? It's an interesting question to ponder.
That's a great thought to leave our listeners with. We've definitely just scratched the surface today. And if you are eager to go deeper into bank reconciliation or really any other accounting topic, remember our sources highlight that farhatlectures.com is packed with resources. They've got more multiple choice questions like the one we did, video lectures, detailed support. It's a fantastic place to build your understanding. Your success really can start there. Thank you so much for joining us on this